Welcome to The Explainer. Today we are unpacking a July 2026 market briefing that exposes a massive hidden divergence, and this is operating right beneath the surface of what everyone is calling a supposedly record-breaking S&P 500. You know, if you felt like the headline numbers just don't quite match reality, well, you're absolutely right. We're going to dive right into the macro policy, the AI splits, and the supply shocks that are really driving this market. Okay, I want to start by hitting you with just one single stark statistic. 37%. Just keep that number in your head for a second, because it instantly shatters the illusion of a uniformly booming stock market. When you hear the financial press cheering about record highs all day, this 37% is the number that tells the real story of what is actually happening in the trenches. So what does that 37% actually mean? It exposes a glaring macro paradox. Look, the S&P 500 closed up at 7,543, so on paper, everything looks phenomenal, right? But underneath those headlines, the trajectory tells a completely different story. We've dropped from a healthy 65% of companies beating the index back in 2023 down to just that 37% today. While the headline index is being dragged upward by a handful of megacap banks and AI infrastructure plays, the equal-weighted index actually fell. The gains are just incredibly concentrated, and they're masking an intensely bifurcated market, where the vast majority of companies are, well, literally being left behind.
And this whole market illusion, it's being fueled by an inflation teeter-totter. Think of it like this. On one side of the scale, we have a massive 5.7% month-over-month drop in energy costs. Retail gas plunged down to $3.70 a gallon. That heavy weight dragged the overall headline CPI down to 3.5%. But look at the other side of the scale. Core inflation, which strips out those volatile energy prices, is just sitting stubbornly flat at 2.6% year over year. So the disinflation we're seeing is almost entirely reliant on the energy sector doing all the heavy lifting. Now, this dynamic leaves the Federal Reserve in a super precarious position. As Fed Chair Warsh puts it, their primary job is to take sticky prices and to unstick them. But because that core inflation is staying so rigid, policymakers are really cautious. Chicago Fed President Goolsbee recently warned that 1 month is no months, meaning a single good headline print driven by falling gas prices just isn't enough to pivot policy. So the Fed is essentially trapped in this cautious holding pattern.
Moving over to the tech sector, because corporate budgets are, finite, this environment has created a brutal divide between the haves and the have-nots. It's a zero-sum game. If you spend heavily in one area, you got to cut from another. The haves, these AI hardware and memory companies like SK Hynix, which is up 27%, and Dell up 7%, are surging. Enterprise clients are just scrambling to build out supply-constrained infrastructure. Meanwhile, traditional software and services companies are becoming the have-nots, like Adobe and IBM. Their legacy software budgets are quite literally being cannibalized to pay for this new AI hardware. To really humanize this data, look at this striking admission from IBM CEO Arvind Krishna. He openly admits they just did not anticipate the sheer magnitude of this sudden budget reprioritization. He says these are not excuses, but they are realities. It was a massive shock to the system. I mean, IBM saw a 7% drop in its infrastructure revenue, which led to a staggering $69 billion loss in market cap. This isn't just some theoretical reshuffling on a spreadsheet, it is a violent reallocation of capital. So, we've seen how this AI boom is eating software budgets alive, right? But that leads us to a much larger structural question. Budgets can be moved around, but what is the absolute physical limit to this AI growth? At some point, we have to shift our focus from digital constraints to the hard, unyielding constraints of the real world. And here's the reality. All of that digital ambition is acting like a giant funnel, slamming directly into the bottleneck of the physical power grid. We are seeing unprecedented hyperscaler compute demand just overwhelming local grids. The power required to train these next-generation AI models is off the charts. Just to put that into perspective, a single proposed project in Genesee County, New York requires 500 megawatts of power. 500 megawatts! That is a staggering amount of electricity for one localized area to provide. And as you might guess, whenever physical infrastructure is strained like that, politics and regulation are right around the corner. We are objectively tracking an immediate backlash of regulatory pushback. In New York, Governor Hochul has imposed a 1-year moratorium on new data centers drawing 50 megawatts or more. Down in Texas, Governor Abbott is calling for bans on data centers in rural neighborhoods. And this really reflects broader public sentiment. Actually, 57% of Americans now oppose local data centers altogether. Now, this physical reality is also inextricably linked to the geopolitical landscape, specifically when we look at global energy supply.
Due to the Iranian closure of the Strait of Hormuz and planned U.S. naval blockades, roughly 5 million barrels of oil a day are effectively removed from global supply. And this specific disruption acts as a massive catalyst for one particular subsector, kicking off what analysts are calling the record golden age of refiners.
To understand why the supply shock is so incredibly profitable for them, you have to realize a truly staggering fact about U.S. supply chains. The United States hasn't built a large refinery in nearly 50 years, half a century. Because we have this hard, physical bottleneck, any global disruption forces our existing facilities to run at absolute maximum utilization just to keep up.
And that exact bottleneck has pushed the Gulf Coast crack spread to a 2026 record of over $62 a barrel. That's the profit margin they're pocketing for turning raw crude oil into usable products. Because of the geopolitical shocks and these constrained capacities, margins have skyrocketed. As a result, EPS forecasts have literally tripled for companies like Valero and Marathon and doubled for Phillips 66.
Okay, so while the physical world wrestles with bottlenecks, let's pivot to the financial sector, which is experiencing a massive boom of its own. Broader corporate confidence has fueled a huge resurgence in deal-making. We are looking at $2.6 trillion in transaction volume for the first half of 2026 alone. That's up 58% year over year. Investment banks are profiting handsomely. Goldman Sachs saw their banking fees jump 55%. A perfect spotlight on this trend is the massive $53 billion joint bid for PayPal at a bold 28% premium. Corporate confidence is absolutely back.
But remember the Great Divergence we talked about at the start of this explainer? It isn't just limited to tech and energy. Healthcare is emerging as a fantastic complement to those increasingly crowded tech hardware trades. Specifically, UBS just upgraded the sector to overweight. Why? Two massive tailwinds: the ongoing supercycle of GLP-1 obesity drugs and the aggressive integration of AI actively accelerating drug discovery. It's the next major AI frontier. So, how do we synthesize all of this into a tactical strategy? Well, if we map out where capital is flowing using the UBS themometer, a really clear picture emerges. You want to favor the AI supply chain and EU electrification. Upgrading and moving into healthcare makes sense right now too. But looking at the other end of the spectrum, consumer staples and discretionary are squarely in the downgrade category, punished by those macro worries we discussed. The takeaway for sure: follow the infrastructure buildouts and avoid the squeezed consumer.
To keep you ahead of the curve, let's look at a roadmap of immediate catalysts to watch. On the macro policy front, all eyes are on Fed Chair Warsh's Senate testimony and the June PPI release, which is expected to show a 6.2% jump. For corporate earnings, pay close attention to ASML and Morgan Stanley. And finally, geopolitically, keep tracking that Strait of Hormuz blockade and the fascinating AI chip diplomacy happening in the UAE.
Which brings us to a final, critical thought for you to take away today. The market is violently dividing into haves and have-nots across technology, energy, and beyond. So the question you really need to ask yourself is this: when you look at your own strategies in light of these structural market bifurcations, is your portfolio on the right side of the Great Divergence? Thanks for joining us for this explainer, and we'll catch you next time.